we think European businesses are trading at very attractive valuations. I mean, one of the things that's interesting is when you buy a European company, it doesn't mean you're buying just European GDP development, European macro. A lot of these businesses are global companies that has a global footprint and operate, is subject to sort of global competitive forces. So a few of our top holdings in our global portfolio are European domicile, Daimler Truck, for example, and Randstad and Rexel. Some of all businesses that just happen to be domiciled in Europe but have a true global footprint. And then on Asia, we're actually very excited about the opportunities in China. If you look at our EM portfolio going back to 2000, we were probably about 20 points underexposed, over 20 points underexposed to China relative to the MSCI EM index. Today, we're at about 10 points overexposed to China relative to the MSCI EM index. It's not because we have a particularly positive view on longer-term Chinese macro. We kind of think things are pretty challenging. What we're attracted to is the extreme valuation that we're seeing in China, where people are basically saying there's no price at which you can entice me into investing in China. Well, our view is if the risk is obvious to everyone, at least you're getting paid to take some exposure. And this is really for the first time in the last 7, 8 years where we think you're getting paid to expose yourself to China. So we've really kind of ramped up that exposure over the last 2 years or so.
Caroline, Japan has been a very popular overweight for global funds this year. And yes, there is an element of political uncertainty there as well. But what ticks the value box in the Japanese markets for you?
Yeah, so for us, it's more at the small cap end. We actually have, in our larger cap global product, we've actually gone to very limited exposure to Japan at this point. Because we think the valuations are not really justified by the underlying fundamentals. You look at the Japanese banks, for example, they generate lower ROEs versus the European banks, but they trade at higher multiples versus the European banks, even assuming interest rates will go to 50 or 100 basis points in Japan. So a lot of what can go right has already been priced in. On the other hand, if you look at what's happened to small cap Japanese companies, in theory, these are the ones where the changes, the improvement in corporate governance and the improvement in the domestic economy may have the most impact on longer-term outcome. But seems like from a flow perspective, maybe it's because of flow, because a lot of people are pulling the trigger for macro reasons. A lot of them have been left behind in the rally. So we find the small cap area in Japan to be particularly interesting, but not necessarily at the larger cap end.